Hello, welcome to handout 16, which is all about finding the optimum capital structure of entities. We've seen several times this semester that a project in general, if it's worth doing, it's worth levering. And what I mean by that is that if you do a project with some leverage, as we saw with our Cowboys versus Conservatives and a couple other examples, we can increase our ROE. Good things can happen for owners in good times. But this is a bit of a double-edged sword because it also is always increasing our risk of bankruptcy at the same time. So that sort of leads us to question, well, where's the balance? What would be the optimal amount of leverage to put into a project? And in particular, right now, we want to focus on what would be the optimal amount of leverage for an entity to have to maximize its value, either to its shareholders or to all its stakeholders. And that's what the focus of this handout is about. And we're going to learn some methods for determining what the optimum capital structure, how much of an entity is, i.e., how much leverage should it have. And so without any further ado, let's jump right in. Okay, so let's see how this whole optimum capital structure thing works here for entities. As an overview, we've already seen several times this term that for the owners of an entity, when we have increasing leverage, that can help boost the return on equity in good times. But we've seen also if you lever up too much, it increases the probability of bankruptcy in bad times. So that sort of leads inquiring minds to want to ask the question, what's the optimal leverage for a given entity and how should we measure it? And also I would say, how should we try to compute it? So let's start like this. Let's consider a project. Should we purchase this entity? So we want to know, as usual, is this going to be an NPV plus project for us? So if we're thinking about purchasing an entity, we're going to own it for a long time. Big cash flow at t equals 0 is going to be the price we pay for the entity, and then we're going to get a series of free cash flow dividends from the entity. And here you can see I'm assuming we're not going to sell it. We're just going to enjoy a bunch of free cash flow dividends for a while. And if we think about this from the perspective of stakeholders, very similar, still an NPV kind of project. And now the price paid is what's paid for 100% of the equity, all the shares, plus all the debt. So that would be assuming we had to refinance all the debt. All the loans would come due and we'd have to find new loans, issue new bonds, that type of thing. And then in that case, what we're going to enjoy are the free cash flows available to the lenders and the owners of the firm, and we're going to discount those by the weighted average cost of capital instead of up here the cost of equity capital. And in both cases, we can maximize the NPV by minimizing our discount rate here, our cost of capital, the weighted average cost of capital here, the equity cost of capital here. And in general, the minimum equity cost of capital might not coincide with the minimum weighted average cost of capital for all stakeholders. So let's look at first the optimum capital structure for all stakeholders. And what we want to note first of all is that we're measuring our leverage by debt over debt plus equity, and this will be, as we've been looking at recently, market value of equity when that's available, otherwise GAAP value of equity. And I'm here to tell you the optimum leverage ratio measured in this way by the debt to enterprise value ratio here occurs when the weighted average cost of capital is minimized. Now remember, this is the case we're looking at for all stakeholders. We'll get back to just shareholders in a bit. So why could I tell you that with such authority? Well, I could be just BSing you, but I'm not actually. It's true, it's really true. Okay, so let's look at the PV total of our free cash flows to all stakeholders. Okay, and that's what I've focused on here. So I've just taken part of our equation here, because we pay what we have to pay for the firm at t equals 0 and to refinance the debt and all that jazz. So that's all at t equals 0. There's not much we can do about that. So I'm interested in what we can do to improve our second term here, and that is going to be the present value of all our future cash flows here. So if we look at this equation, what we've got in the denominator is, the key thing in our denominator is our weighted average cost of capital. So just mathematically, if we minimize the denominator here, okay, we're going to maximize our PV total for all of our stakeholders, and that's going to give us maximum NPV for this project for all. So that's the key idea. It just comes from mathematically looking at this. The free cash flows that we estimate from the firm, they're going to be what they're going to be based on our assumptions of growth in sales, how much we can cut costs, all that sort of jazz. But the weighted average cost of capital is a function, as we know, of how much leverage the firm has. So minimizing this is going to give us the optimum leverage, the optimum capital structure. So how do we find this minimum weighted average cost of capital that's going to maximize our NPV to all stakeholders? Well, here are the steps. Okay, so first we want to agree, as we've sort of alluded to previously, that we want to measure leverage with our debt to enterprise value ratio, right? Debt over debt plus market value of equity, if it's available, right? Otherwise, just GAAP value of equity. And we can simplify that to D over D plus E. So next up, we want to note that the cost of debt capital and the cost of equity capital both increase with increasing debt to enterprise value ratio, right? And this is true because it's empirically true. As the firm gets more leverage, there's more risk of bankruptcy, which isn't good for anyone, right? It's not good for lenders. It's not good for stockholders. So therefore, as the firm levers up, both debt holders and shareholders are going to demand higher returns on their investment. And that leads to, that's another way of saying, higher cost of capital for the firm. Okay, so we're going to have to estimate the cost of debt capital for a given firm and the cost of equity capital at various levels of leverage. And we're going to use market data for RD in particular for the cost of debt capital. And we'll probably use CAPM and Hamada's equation for the cost of equity capital. And we could use something like the opportunity investment model or something like that also, and it would be helpful if it were spelled properly. And then, once we've made these estimates, for each of these various levels of our WD and WE, right, in particular increasing WD here, we'll compute the weighted average cost of capital, and we're just going to look at all of these that we have, and we're going to see which one corresponds to the minimum weighted average cost of capital, and that's going to be our optimum debt to enterprise value ratio. And why is that true? Again, that's true because when we make this minimum, we make this denominator minimum, and therefore the present value of all these guys is maximized. Okay, so let's jump right into an example. Let's look at Super Consultants Inc., or SCI, and let's find the optimum capital structure for all stakeholders. So what are the key features of this firm? It provides consulting services to small and medium-sized businesses. Sounds good. Stable, steady business with stable future prospects. These are our usual simplifying assumptions that makes the accounting so much nicer for us. So the key thing here is going to be slow to no future growth. As we saw in the previous chapter, that makes everything very simple accounting-wise for us. It's a well-managed business, and right now it's debt-free. So D over D plus E is equal to 0 right now. Okay, so TTM operating data, how's it been doing for the past year? Well, its tax rate has been 40%, and since it's a stable company, that will be true going forward, has debt equal to zero, as we just noted. All of its revenue is collected immediately, all of its expenses are paid immediately, so that's great. That super simplifies the accounting. There's no accounts receivable, no accounts payable, any stuff like that. It's got no PPE, so we don't have to worry about depreciation. And you might be saying, hey, this is too artificial, but it's really actually not for this type of consulting company. If you have a consulting company like this, you're renting office space, that sort of thing. It really could be true that effectively you have very low or no accounts receivable, very low or no accounts payable, and definitely you wouldn't have any PP if you're just renting space month to month or something like that. All right, so now let's see how their operations have been doing. So what are we going to look at? The income statement. All right, so they've got 88, let's say million, what the heck, they've got 88 million in revenue in the past year. Let's make this annual. Okay, and because again, it's a steady state firm, that was true in the most recent year, it'll be true this year, it'll be true the year after that. So revenue of 88 million, SGA expenses 70, so their EBIT is 18 million. They have no interest, and their earnings before tax is therefore equal to their EBIT. They pay their tax rate is 40%, so 40% of 18 is 17.2, and we subtract that from 18 and get 10.8. Okay, so that's their net income. So this is pretty good, more than 10% net income margin. If it's steady and reliable, that's not bad. Okay, so SCI, God help her, SCI CFO asks us to find the optimum capital structure of the firm using this minimum weighted average cost of capital method and the corresponding weight of debt and debt cost of capital and equity cost of capital for the firm. So she provides us, to get us started, she provides us with some additional information. The risk-free rate at the time, she believes, is 6%, and she's gone out and measured that by treasuries. The market rate, this is going to be for CAPM 4RE, the market rate of the stock market on average annual return right now, 11%. She believes the tax rate, we've already learned, is 40%, and that is tax divided by EBT, where we assume that EBT is equal to taxable income, which has been our assumption pretty much all along. And so our strategy to figure this out for the CFO is, let's consider 1, 2, 3, 4, 5, 6 different levels of leverage measured by debt to enterprise value ratio. And for each one of these levels, what are we going to do? We need to estimate the cost of debt capital and the cost of equity capital. And remember, these are going to increase as our leverage ratio, debt to enterprise value ratio, increases. Okay, and for each one of these, we will compute the weighted average cost of capital, which we already know how to compute. Here's the formula for it again. And so when we're done, we're going to have weighted average cost of capital for no debt, 20% leverage measured by debt to enterprise value, 40%, 60%, 80%, 90%. And now it's pretty simple. Once we've got all of those, the case with the minimum weighted average cost of capital is going to be the optimum leverage for this firm. And with that in our pocket, we will report that, as well as the optimum weight of debt, the cost of debt capital, and the cost of equity capital, back to the CFO. So let's get started. So first of all, let's start by estimating the cost of debt capital here. And if I can go ahead and do that, there we go. So I want to emphasize we're looking at debt capital now. So we want to do this for all of these different cases. And here's how you do it for debt, okay? And okay, is you want to go out and find in the industry comparable firms. Our firm right now has no leverage. You want to go out and find comparables that have debt to enterprise value ratios around 20%, 40%, 60%, 80%, 90%. This is the type of thing that folks at investment banks do as a service for their customers all the time. So if you're interested in this, this is something you might find yourself doing at an investment bank. And the once we've got those comparable firms with these leverage ratios, we compute their pre-tax cost of debt capitals. How do we do that? We just go right from their balance sheets and income statements, where if we're just using financial statements for the whole firm weighted average, the pre-tax cost of debt capital is equal to interest expense divided by debt at beginning of the period. So that's the prior year's balance sheet, okay? And we're assuming, since these are comps, we went out and did this for comps, okay? They're in the same industry, they have similar customers, similar products, stuff like that. The only difference is they've chosen to capitalize themselves in a different way. So since they're comps, we assume that if SCI were levered the same way, its cost of debt capital would be the same. So this is a comps-based, marketplace-based analysis to find this data, okay? And so something like this might, well, once you're familiar with this, it might take you a day. It might take you 3 or 4 days the first time, but once you've done some of these, it might take you a day. Also depends on the company, how many comps it has. If it's not a publicly traded company, this won't work at all, et cetera, et cetera. But I'm assuming right now it works, it has comps, it's publicly traded, et cetera, and all the comps are publicly traded, et cetera. So we go out and we spend our day or 2 or 3 on this, okay? And we find for a firm like SCI, if it has no debt right now and it was just going to take out a little itty bitty loan, it would be expected to pay about 6.75% on that loan. If it wanted to lever itself up to 20% debt to enterprise value, it would be riskier, and so it would have a weighted average pre-tax cost of debt capital of 7.25%. If it levered itself up more to 40%, that cost of capital, debt capital, is going to go up again. Why? Again, because things are looking good with leverage, but it also, as we know, increases bankruptcy risk in bad times. So we do this all the way up to some comparable firms, and you want to find more than one comp, right? So we find 2 or 3 comps here that are very levered, 90%, and on average, their cost of debt capital is 16%. So we have a pretty big range here, right? More than a doubling of the cost of capital from essentially no debt to very highly levered. And key point behind this, of course, as I've said, is that similar firms are going to pay increasing interest rates as their leverage increases. So this works for the comps. We would assume because they're comps, it would be true for FCI. So this is good. So we have one big piece of data. Now we got to do the same thing with the equity cost of capital. Okay, so let's go ahead and look at that. So we need to estimate the equity cost of capital for all these levels of debt to enterprise value. And this is one reason, frankly, that CAPM is a very popular model, even though, as we know, it's got a lot of problems and oftentimes doesn't work very well. It's really easy to do this, find all this data, the equity cost of capital for 0% leverage, 20%, 40%, 60%. It's really easy to estimate that using CAPM and Hamada's equation. And that's not an excuse, but it's a fact on the ground. Okay, so here's our CAPM model again, which everybody's familiar with. We've computed equity cost of capital with this a couple of times, and we know what all these things are. This is the cost of equity capital estimate for this firm. It's equal to the risk-free rate, which we'd measure probably by treasuries, and then plus that increment for market risk, which is the market return rate minus the risk-free rate, times beta j, and beta comes from that regression of the company we're considering versus the market, right? So beta comes out of that regression. Okay, we've been through that before, so let's move on to that. And then we're going to use this Hamada's equation, which I did bring up with us briefly in the previous chapter, and I promised you that you would not have to compute things with Hamada's equation. That's still true, but it's central to what's going on here, so I want to show it to you and show you how it works here. So Hamada's equation comes into things like this. We're going to use, for each of these levels of leverage, we're going to use the CAPM equation to estimate the equity cost of capital. And we're going to use the Hamada's equation to keep estimating beta for 0% leverage, 20% leverage, 40% leverage, 60% leverage. You can see here in this equation, nothing else has anything to do with the leverage of the firm we're considering. The risk-free rate in treasuries doesn't care. The total market rate doesn't care. And again, the risk-free treasury rate doesn't care. So we have to account for the leverage increasing this equity cost of capital through beta. And that's what Hamada's equation does. So Hamada's equation says that a levered beta for a company is equal to the beta that we find for that company with no leverage. That's what BU stands for here. Beta of similar firms, or the firm we're looking at with no leverage. And beta L is beta of similar firms, comparable firms, same firm we're looking at with leverage. So the leveraged beta is equal to the beta with the firm when it has no debt, okay, times this whole mess, okay? And the key thing you have to see with this whole mess is that as this term gets bigger, the beta is going to get bigger, right? Actually, this whole term, as this whole thing gets bigger, the beta is going to get bigger. Okay, so for someone happily has gone out and done an SCI to market regression for us and found that the beta for SCI in its unlevered state is 1.1, okay? So then we can just use now Hamada's equation. There's nothing in here that we don't know. We'll put in 20% for this ratio, 40%, 60%, and we know the tax rate is 40%. So we'll be able to estimate beta leverage for each of these. So let's see how it works here. Okay, so if we have 0% leverage, the unlevered beta is the levered beta. If we have 20% leverage, the beta of the firm, because it's riskier now, has increased to 1.27. And again, that's going to directly increase the cost of equity capital through the CAPM equation. And if we have 40% leverage, the beta goes up even more. 60% leverage, it goes up even more. 80%, 90%. And it's going up mathematically. Again, you don't have to compute this, but it's going up mathematically through that equation. Okay, and here again is that equation. And so now that we've got our beta in each of these cases, we can compute our cost of equity capital for each level of leverage, okay? So with the unlevered beta of 1.1, cost of equity capital 11.5% from the CAPM model, and 20% leverage, because this is increasing, we get a higher equity cost of capital, 12.3%, 40% it gets even higher, 60% higher, 80% higher, and 90% wildly higher, okay? So unlike our range of debt cost of capital, which increased by about 100%, we've got this increasing by about 400%, okay? So very, very big difference, and that sort of makes sense because in bankruptcy, owners get nothing, right? And in bankruptcy, the bondholders or the lenders have a claim on the company, but shareholders usually get nothing, okay? And so, like I've said here, the cost of equity capital is increasing with increasing leverage, just like our cost of debt capital, but more pronounced. Okay, so now I think we're ready I think we have everything we need now to compute our weighted average cost of capital for each of these levels of leverage. And then we know the minimum weighted average cost of capital is going to correspond to the optimum leverage level. And how do we compute that weighted average cost of capital? With our standard unchanging weighted average cost of capital equation, that the weighted average cost of capital is 1 minus the tax rate, our 40% times our cost of debt capital at this leverage ratio, times the weight of debt with that leverage ratio, plus our equity cost of capital at this leverage ratio times our weight of equity. All right, and I've got on the next page, I've got all of these cases worked out for us. So I'm calling no debt case 1 and 20% D over D plus E case 2, et cetera, et cetera. So let's see how it works here. So the first thing we want to have is we want to have a nice table like this that shows everything that's going on to the CFO on one page. So the first thing that we show her is we went out and did this work on comps of different leverage, and we found that, for example, for comps with 60% debt to enterprise value, that the cost of debt capital is about almost 11%. And for our very highly levered comps, we found that their cost of debt capital was about 16% on average. And then we had to go through and do the similar thing with the equity cost of capital. So first, we went out in the marketplace and just looked up comps to get our debt cost of capital. And then for our equity cost of capital, we used our CAPM model with Hamada's equation. And we saw on the previous page how that worked out. So we found for comp firms that are levered to about 40% debt to enterprise value cost of equity capital, it's about 13.7%. Also, while we're here, always good to check our work. The cost of equity capital should always be higher than the cost of debt capital. And that's because the debt holders have their contract, right? So even if the company flames out, they're going to get something. And the shareholders, if the company goes bankrupt, almost always shareholders get nothing. So they have higher risk, so they should be demanding a higher discount rate. And we're seeing that in the numbers. 13.7% is greater than 9%, 16.45% is greater than 10.85%, et cetera. So that's just another way you can check your work, make sure you're doing something reasonable. Okay, so now I think we have every piece we need to compute our opportunity cost of capital for each of these cases, 1 through 6. And that's exactly what I've done down here. Okay, so here's my WD, 20%, 40%, 60%, etc. Okay, and 1 minus the tax rate is 40%, that's always 60%. And then I go through and I just plug everything into our weighted average cost of capital equation here, and I find our weighted average cost of capital, if there is no debt at all, it's equal to our equity cost of capital. That makes sense because we have no debt, okay? And if we lever the firm up to 20% debt to enterprise value, the weighted average cost of capital comes down, interestingly enough, and that's because of the tax shield effect and things like that, to 10.73%. This is coming down because we have this nice tax shield effect there. And then for case 3, it's down even more, 10.4%. And now with case 4, it's starting to go up again, 10.5%. And here, if we lever up a lot, 11.2% and 12.8% if we're very highly levered up here at 90%. Okay, so what do we know? We know that the present value of the future cash flows for this firm is going to be maximized when the opportunity cost of capital is minimized. So that is definitely case 3, right? So case 3 is our winner, okay? All right, so case 3 is it. All right, so we choose case 3 with our debt to enterprise value of 40%. It's really that simple. I mean, you can see there's a lot of work behind this, right? You've got to go out and get all this data for RD in the marketplace, and then you have to trust your firstborn to the CAPM model down here, which we all know is probably not such a great idea, but it's better than nothing, and it's what we got. Okay, so let's do our computation for this case, case 3, just to make sure that we can all do this. So we're just going to plug in our weighted average cost of capital equation with everything we know. So 1 minus the tax rate is 60% because the tax rate was 40%, okay, times RD. I've got to look that up. I don't remember. Of course I don't remember. So that's 9%, okay, so that's 9%. And the weight of debt there was 40%. And then plus, I have to look up the equity cost of capital here, which is 13.7% here, okay, 13.7% times, and if the weight of debt is 40%, the weight of the equity better be 60%, okay, and let's just take this over to Excel to make sure that I don't have any typos in there, and we've got to copy it, that would help. Okay, and we get 10.38%, and I believe that's correct, which we should be able to verify. Yep, 10.83%. So you can see how by hand all of these guys are calculated. So that's it, we're done. It's honestly that simple. We just go back now and report to the CFO, the optimum leverage ratio equals 40%. And that's measured, again, just because there are different ways to measure leverage. We're measuring by debt to enterprise value ratio here. And we would also want to report back to her the corresponding RE of 13.7%, the RD of 9%, and the weighted average cost of capital of 10.38%. Okay, so in the real world, I'm always interested in the real world. Hopefully you are too. So in the real world, how does this actually get used? There are many ways in which it's used, but there are two very common ways which may be of interest to you depending on where you want to go in marketing or finance or analytical fields, quantity, general analytical fields of business, etc. Okay, so track number one for this might be if you're interested in becoming a CFO. So that would fit right in with what we've been working on here. So let's go a little further with the CFO. So SSI's CFO asked us to do this because she is interested in actually getting an optimal cap structure for the firm. And so let's say that the market value of the equity is 100 million and the debt of the firm, as we know, is 0 when she gives us this assignment. And we found for her that the optimum capital structure is 40%. So what's she going to do? If she wants to recapitalize the company to move it into the optimum capital structure, she's going to have to do some accounting stuff. Oh my God, you thought you had finally gotten over accounting. You never get over accounting in finance, okay? So how could she do this? Well, she'd go out to Wells Fargo, JP Morgan Chase, Bank of China, something like that, and she would want to get a loan for $40 million. So that means she's going to get cash of 40 million from the loan, and cash is an asset, right? So I'll put an A there, and she's paying for that. Here's where the risk increases, right? She has the loan liability now. The firm does, SCI does. She's just the CFO. She's operating as an agent for the firm. So the firm now has this liability. So that's step number one. So now she's got this $40 million. What does she do with that $40 million? Well, she buys back. She goes out on the marketplace. She calls Interactive Brokers. She calls E-Trade, and she has them on the company's behalf, buy back 40 million worth of the shares of the company. Remember, there's 100 million total, so these get bought back. So what happens when you buy back shares? When you issue shares, it's paid in capital, right? So when you buy them back, it's got to be the same thing. It's got to be paid in capital, and that's going to be the 40 million, okay, buy back shares. Okay, So she's buying back those shares, and that's equity, right? Paid-in capital is part of equity. And what's she do when she buys back those shares? She throws those shares into the burn barrel. She's reducing the share count, right? That's the idea. She buys them back and she burns them, okay? And I know you accounting majors know they really go into treasury, share stock, but whatever, that's not really important for us. A good simple way to think about it, which always works in finance, is you just say you're throwing those shares in a burn barrel and burning them. Okay, all right, and so now the CR is, what did she do to buy, what did she use to buy back those 40 million shares? That was the cash. 40 million, okay, and that was the cash that went out the door to the broker used to buy back the shares. And that's it. That's one way in the real world that optimum capital structure is used. Okay, so second way in the real world that this is used all the time, okay, is if you are a private equity firm and you could be thinking of buying SSI for the asking price of 100 million, and that would give you 100% of SSI stock. So now we have a scenario where SSI is for sale. It's got no debt, it's for sale. The asking price for all of its shares, 100% of its stock, is 100 million. So if you're the private equity firm and you want to optimize SSI's capital structure after you've purchased it, how are you going to do this? This is something private equity firms do all the time. When they buy a firm, they recapitalize it into what they believe is the optimum capital structure. So here's how it would go, okay? So first thing you note is that purchase price is 100, and that's going to be comprised of D, which is the loan going to be taken out by the company, and E is going to be your own funds. So here we have it. So E is going to be your firm's own funds that you're going to put to pay a portion of this purchase price. And D is going to be a loan taken out not by you. This is very important. This is a loan that's going to be taken out by SSI, your target takeover company itself, on the day of the sale. So on the day of the sale, the company takes out the loan, and it's going to be for 40 million, right? And you put in 60 million of your own funds. You put all these funds into a wheelbarrow, and you take this wheelbarrow of 100 million over to the prior owners of the firm, and they get the wheelbarrow of $100 million, and you get all the shares of stock. Okay. So how has that worked here? We've got, in this case, so we know that we've got our 40% debt to enterprise value is what we want. So we know that we're going to need a loan. The company is going to have to take out a loan of 40 million. So again, you're going to purchase SCI with 60 million of your own funds, and with, with over here, fella, there you go, 40 million of, from what? From a loan taken out by SSI on the day of closing. Okay, so again, you get your wheelbarrow, right? And you put in 60 million of your own funds, and you get SSI to get this loan to it from JP Morgan Chase, right? And you throw their 40 million in the wheelbarrow, you take the wheelbarrow over to the prior owners, you give them the total of the 100 million that they demand to give up all their shares, you get all the shares. Okay, and that's it. For those of you who can't sleep without learning more about this, there's a whole section here on finding optimum capital structure, not for all stakeholders, but for equity investors. It's incredibly exciting. It's also in the textbook in prose form. So if you're super interested, you're encouraged to look at that. But as you can see, it's in gray, so you're not going to get homework on it. You're not going to get an in-class quiz on it. You are not going to be responsible for it on the next exam. So for all those reasons, I think I'll call it a project right now and look forward to catching up with you again soon. Take care.